So why will the Fed not cut rates this year, or why shouldn't they, in your view?
Let's look at financial markets, of course, as much as they have eased, and then ask the question, is it really surprising that the employment report was so strong in January? Is it really surprising that inflation is beginning to show signs of moving higher? Because think about it, since the FOMC meeting on December the 13th, we have seen a significant rally in the stock market. We are basically all-time highs every day. We've seen significant tightening of IG credit spreads, of high-yield credit spreads, of loan spreads. You've also seen significant issuance of IG bonds. January was the biggest issuance in the history of January's going back in time. You also had high yield issuance has been strong, loan issuance has been strong, and finally I've also seen IPO activity has really started coming back, and M&A activity has also started coming back. So with this very substantial tailwind of easing in financial conditions, it is really not surprising that we should begin to see more tailwind to employment, more tailwind to consumer spending, because now the wealth effect is higher because of stock prices going up and credit spreads being tighter. All that should mean that we are delaying Fed cuts, and therefore we will probably have now a few more quarters of strong growth before we begin to see any meaningful slowdown.
Well, and I want to get to some of the slower points we are seeing maybe in terms of the U.S. economy. But having said that, first I want to ask, why put a time frame on it? Why say it's not going to happen this year, especially when there is still a fair amount of uncertainty about the economy and its behavior and how we kind of get towards the end of maybe a cycle?
Well, that's a good question, Carol. But if I, on my Bloomberg screen, type ECFC go, you get to see the economic consensus expectations to the U.S. economic outlook. And if you look at how expectations have evolved for growth in 2024, you have literally seen since the Fed pivot in the meeting on the 13th of December, that growth expectations for the U.S. economic outlook for 2024 have really gone up dramatically. And that's telling you that the consensus is beginning to come around to the view that maybe there is no near-term slowdown. And therefore the timeline really here is that if there is no near-term slowdown, and if we still have financial markets doing so well, well, then it is probably going to take a few more quarters before the Fed succeeds with getting inflation back to 2%. So the short answer to your question is that I still think that with financial conditions being as easy, or in plain English, with the stock market hitting new highs all the time, it's just really difficult to see the Fed begin to cut rates when you have the S&P at all-time highs every day. Because think about what that would do to the S&P, what it would do to financial conditions. It would ease them even more, and that would raise the risk for the Fed that you would get even more upside pressure on inflation, which we already have from wage inflation is still very high. You also have that NFIB survey of selling price expectations for firms, also still very strong signs of inflation in the pipeline. And finally, you also have a number of indicators across the board for labor markets, for what's going on in terms of ISM, prices paid, services, manufacturing. All that points to more inflation pressure still in the pipeline.